So this is a mess, right? I mean, this is a basic financial crisis 2.0, if you will. You're basically putting your money in one asset that we know is already troubled. I think the 10,000 break to 9,000 would be a case of the all-out bloodbath that would actually
Hmm.
put in the bottom.
Analysts are expecting a bailout here by the Swiss National Bank and potentially regulators. What are Gareth Soloway's thoughts?
Yeah, so this is a mess, right? I mean, this is a basic financial crisis 2.0, if you will. And what we're seeing here is Credit Suisse, which already was in a tailspin. And if you look at the chart, right, the daily chart, you have JP Morgan Chase, you had Goldman basically trading near multi-year highs just over the last couple months before this recent collapse. But Credit Suisse was nowhere close to that. It was already in a downtrend. It was already at multi-year lows. So what that was telling us is that smart money knew this was the bank that was going to be in trouble. It was going to be one of the big ones to be in trouble first when we got a situation like this. And when you have interest rates rising this dramatically, right? So we're not just talking about, oh, it's, 4 point something on the Fed funds or 5%. We're talking about where it's come from. So it's the velocity of the move that has broken the system. And part of that is the fact that the Federal Reserve basically mismanaged things, right? They said everything was transitory when it came to inflation. They were wrong and had to play catch up. So again, even when we were out of a financial crisis due to COVID, they still said, oh, we're going to still leave it as is, zero interest rates, essentially free money, because we don't want to rock the boat. Well, the end game is they had to play catch up here. And now you're seeing whether it was Signature Bank or SBNY or even Credit Suisse here, these are some major issues. And that's going to be something that the European Union has to deal with now.
Any particular thoughts on Credit Suisse and the stock? Short, buy?
Yeah, so this is the key, folks, and I'll say this is I've been nibbling on a few different financials, like a little bit of Goldman Sachs, a little bit of JP Morgan, and I've been buying some ETFs that are spread amongst many of the banks out there. And the reason I'm not touching Credit Suisse is much the reason why it was a bad idea to touch SBNY or Silicon Valley Bank is that you're basically putting your money in one asset that we know is already troubled, and we don't know how bad this is going to get. So my recommendation is go with the best of breeds if you're going to nibble small, or go with an ETF that spreads your risk out across the board. But Credit Suisse, this is one of those things. It's like a Lehman moment potentially, where we could wake up one morning and it's shut down, much like we saw with Lehman Brothers.
As we've covered, we've had three big bank failures: Silvergate, SVB, and Signature. And we've had Larry Fink, the CEO of BlackRock, which is the world's largest asset manager, raising the prospect of even more bank seizures and shutdowns. He's saying we don't know yet whether the consequences of easy money and regulatory changes will cascade throughout the US regional banking sector, with more seizures and shutdowns coming. Big picture, do you think that this is where we're headed?
I do. I don't know how many more seizures will occur, but I do agree with him that inflation is going to remain elevated above that 2% mandate that the Fed has said. I've said this for the last year or so. To get inflation down from 9 or 10% to 5 or 4%, that's the easy one. That's like, you lose 10 pounds at the gym. To get that final six-pack, it's a lot of work. And that's where we are at this point, where, again, it's going to be very tough because, remember, wages skyrocketed. You had companies that were paying $10 an hour that now have to offer $20 or $25 an hour. They weren't able to pass that cost over to consumers day one. So what they're going to do to keep their margins in line and get those margins back is inch that into the consumer's pocketbook, essentially, over multiple years. And that's going to take some time. So you're going to be looking at elevated inflation rates. And again, we have to be ready for something probably around 3 to 3.5% for multiple years to come, which is the scariest thing of all, because now we're in a crisis where normally the Fed could be like, oh, well, let's lower rates to save the day. That can't happen now. They're basically at a point where, yeah, they could pause, but we just saw PCE numbers recently that were sky high. They can't be cutting rates yet.
All right, before I unpack in greater detail what you expect from the Fed, I want to just get your thoughts on your trading approach regarding the banking sector, because you said you are nibbling on some of the bigger players. Tell us more about that.
Yeah, so on a chart like Goldman Sachs, I mean, we've now come down just in the last few days from $350 to near $300 a share. I mean, these are banks that may have some exposure, but they're a lot more nimble and bigger than a lot of the regionals out there that are having a lot of trouble. And you have to assume that their management is better too. And I think that's one of the big things here is, yes, it's partially the Fed's fault that you saw these collapses because they raised rates way too fast and these banks weren't prepared for that. But at the same point, their management was way behind the curve. To be being paid what these management companies and CEOs are being paid at these banks, and to fumble the ball like this is not acceptable, frankly. And I think they have to be held accountable, not just the Federal Reserve, but Goldman Sachs, JP Morgan. These are best of breed banks. So at least in the near term, I think you play them for a bounce. I'm not saying that, again, this is a buy and hold for the next 5 years, but you're looking at a short-term technical bounce that's probably getting close.
How short term?
Oh boy. So, I mean, for me, it's more of a price point. So if we look at the chart here on Goldman Sachs, I would be looking at a bounce back to about $330 to $340, which nets you about 10%. So you look for a 10% snapback over the next couple of weeks to month, and then you kind of step aside and say, okay, let me reevaluate. Because remember, this is the kicker, is that we are going to go into a recession. There's no way around it at this point. I just think it happens in the second half. And then once we go into a recession, then these banks are going to be put under new additional pressure from economic issues.
Do you think that Powell can continue with this approach? Because the markets seem to be pricing in a potential pause in hiking in the upcoming March 22nd meeting. There are thoughts that maybe to save face, he'll throw in 25 basis points, but certainly 50 basis points is out of the question. What are you expecting for the next meeting?
Yeah, so I'm expecting 0 to 25. And again, I think in the next few days, we're going to know whether it's 0 or 25. If things get worse, it's 0. If things calm down, then I think he might do 25. But you had mentioned, too, that the Federal Reserve had telegraphed their rate hikes, right? And it makes it think like, oh, well, how are these banks so dumb to not recognize when he basically said, hey, guys, we're raising X, Y, and Z, so be ready for it. The problem is that in reality, the Fed has almost no trust value, meaning that, where's the credence when, in 2018, they basically reverse ship immediately. They've been basically the drug dealer to the market, just feeding it liquidity constantly over and over again at the littlest issue out there. And so you can't blame people for saying, oh, well, the Fed will just save us if something goes wrong, and starting to believe in that when the Fed has made us believe. And now all of a sudden the Fed's deciding to stand up and cut off the supply. That's my issue there, is with the Fed, is that they're not fully trustworthy in what they say over time. Looking at the regional banks and what's going on in Europe and saying this is really bad, but this isn't even close to as bad as it has to get before the Fed is willing to actually cut rates if inflation is above 2%. And that, I think, is scary to me because, what does it look like if it gets to that point where the Fed actually has to lower interest rates?
Yeah, what does that look like, Gareth?
I would say S&P sub 3,000 at minimum. In fact, per the S&P chart here, that's what I'm expecting. So I'm expecting, again, a little bit of a break lower here. We're obviously seeing downside down to basically the pre-COVID highs, which is right around 3,400. That's first stop. We're about 450 points away from that at this point. And then ultimately, I think by year end, we're at 3,000 or sub 3,000 on the S&P 500. So it's going to get worse. And this is the issue, is that, remember, the markets have been conditioned, investors have been conditioned to say, anytime we hit a hardship, anytime we get into a recession, the Fed will bail us out. The problem is we're going to get into a recession in the second half, and the Fed's hands are going to be handcuffed. They're not going to be able to bail us out like they have done in the past.
And you're saying that yet if the Fed does actually start to cut, that's going to be worse for the markets?
So if they actually get to the point of cutting, we are probably in such a catastrophic event in the market system, in the economy, that's why they're doing it. So I'm thinking that you're going to have to see like north of 8% unemployment, maybe 10%, before they cut in the next 12 months. And again, I don't know if that unemployment number will happen, but we have to realize that if they start printing money again with inflation at 3.5%, where's the next stop? Is it 15%? Is it 20% before? And so they are realizing this as well. We know that you mentioned this earlier, that Volcker had an issue where he kind of lowered rates too quickly. Jerome Powell says he doesn't want to repeat that. So he's very aware of that issue that could arise. And so he's going to try to hold back as long as possible from cutting, as long as inflation's above that 3% area. Right.
The markets had been trading on the idea for the longest time of bad news is good news, meaning what it means for the Fed. But there does come a point where bad news is just bad news, and that is seen across the board in terms of equities. Your outlook for gold, though, is still very positive. You still hold the view that gold will outperform other assets this year.
Yes, and I continue to be in that camp, and it's having a beautiful move up today on the day. Obviously, fear, any sort of fear, instability. Number one, people run into the U.S. dollar right now. Number two, gold is that recipient. And weirdly enough, I know we'll get to it, but recently Bitcoin has been the recipient as well, which is really, really fascinating to see. But for me, gold is putting in a bull flag that started in 2020, and at some point, this is going to bust out to the upside and have a big move up. If you look at the 1970s chart, this is the same pattern price. In fact, I'll show this real quick. So we had this start here in 2018 on the chart where we went up for 2 years to 3 years. We've now consolidated for 2 to 3 years. If we go back to the 1970s, we can see that same sort of pattern recognition during that inflationary period. Gold went up for 2 years to 3 years, consolidated, and then the next rip took it from about $110 to almost $900 an ounce. Now, again, I don't think it's going to go to do a 9x or anything like that. I think a 4x, 3x is probably more in line because people have an option of Bitcoin and crypto now. But nonetheless, the history is repeating here as the inflation numbers are repeating.
Break down your Bitcoin outlook for us.
So something you mentioned, which you can't help but smile at it, is that the fiat system, the banking system, is actually helping make the case for why Bitcoin is a necessity here. And I think that that's something that we have to all kind of take note of, and then also say this is a major step. I think we're going to look back at this period and say this is one of the key moments why Bitcoin is now such a major asset in 5 or 10 years from now. So ultimately, do I think that the selling in Bitcoin is over? No, honestly, I don't. I think that in the short term, the fear in the banks caused a lot of money from banks to go into Bitcoin as a safety play. I also think that we saw USDC decoupling over last weekend. People said, hey, I don't even want to be in stable coins right now, so I'm going to go into Bitcoin as well. So I think that was kind of the reason for this latest move. I think once the financial system comes a little calmer, then you might see Bitcoin head down. And I still worry that if I'm correct that the S&P is going to drop another 25% or so from here, then I do think it drags, just by fear, it drags cryptocurrencies lower overall. Now, long term, I'm a huge bull on Bitcoin, and I think I get classified as a bear because I've talked about a fall since 69,000. But long term, I still love it. I think it's the future of the digital gold world. And I think that there's a real need, and we see it today. There's a real need for Bitcoin. Look,
you did say it was going to break and not hold at 25K. It's at around 24,200 at this time. You have mentioned that your short-term target is for Bitcoin to pull away all the way down to 13,000 and even to 9,000. Is that still your sort of short-term call on Bitcoin? And exactly in what timeline?
Yeah, so I think you have to be looking at in the course of this year. By the end of the year, I likely think we'll at least hit 12 to 13,000. And the basics of this are that, number one, we have to still wait for regulation. So especially with the uncertainty, I mean, yes, the banking situation has pushed money in here, as has the USDC issues. But I think ultimately we have to remember that you're at a point where regulation is still keeping big money out, and that people are still subject to absolute fear. So when we get in a scenario where we start to see more and more panic selling in the markets, in the economy is starting to dip into recession, my guess is it gets sold across the board. So assets, maybe gold survives in that period and doesn't dump, but even during COVID, if we remember the COVID collapse, even gold dumped. And that's where I kind of think that we're going to see the big dump on Bitcoin, one final flush down. I'm going to be waiting and nibbling kind of once we get in that sub 15,000 level, all the way down to 9,000 if it gets there.
Yes. I know it's out there, and I know a lot of things can happen, but right now, what are you looking for Bitcoin to be at?
Yeah, so Bitcoin ran into a ton of resistance. We can see again on the chart here, the high from August of 2022. That's exactly what we've hit over the last couple days here, as well as about a month and a half ago. And my guess is what we're going to do is we're going to come down and test this level of two major trend lines that coexist here at around 18,200. That's going to be a technical bounce level, no doubt about it. But if we break that, then we head to that 15,600 level. You break 15,600, and then the next stop is that that 12 to 13,000 level. So again, my projections are showing that eventually that will happen, likely by year end, and we should revisit that 12 to 13,000. I think the 10,000 break to 9,000 would be a case of the all-out bloodbath that would actually put in the bottom. As you think about how many people probably have stops right around 10,000, and that break point would create max fear, which actually is how bottoms are made.